In this video, we're going to talk about liquidity pools in crypto and why they're important to understand if you want to invest in crypto. Welcome to Crypto Made Simple, the best place to learn everything you need to know about crypto. So, what is a liquidity pool? In the most basic terms, a liquidity pool is just a collection of funds that can be used to trade assets. The key word here is liquidity. This means that the funds in the pool can be easily converted into cash or other assets. It's basically like a pool of money that people can use to buy or sell assets. You might be wondering, why are liquidity pools important in crypto? Well, they play a big role in making sure that the crypto markets are efficient. By having a large pool of liquidity, it makes it easier for buyers and sellers to trade assets without having to worry about finding someone who wants to buy or sell the same asset. This is because there is always someone in the liquidity pool who is willing to buy or sell the asset. They are also important because they help stabilize the price of assets. This is because if there is a lot of liquidity in the market, it will become more difficult for the price of an asset to fluctuate dramatically. So, in short, liquidity pools are important because they help to make the crypto markets more efficient and stable. Now, you might be asking yourself, how do liquidity pools work? Well, there are a few different ways that liquidity pools can work, but in general, they all work by having a group of people who are willing to buy or sell an asset. These people are called liquidity providers. The liquidity providers will put their money into the liquidity pool and then they will trade with each other. This trading activity helps to provide liquidity to the market, and it also helps to stabilize prices. Liquidity pools are also created through something called smart contracts. Smart contracts are simply agreements that are written in code. They can be used to automatically execute trades between liquidity providers. This helps to make the process of creating liquidity pools more efficient, and it also helps to reduce the costs associated with trading. They reduce the cost of trading because there's no need for a middleman to execute the trades. You would also want to know about the different types of liquidity pools before you get started. There are a few different types of liquidity pools, but the most common one is called a centralized exchange. These are exchanges that are run by a central authority, like a company or a government. For example, a popular centralized exchange is crypto.com. This would be like if a supervisor was looking after a swimming pool, making sure that everything is safe and clean. These pools will have a lot of rules and regulations. Some will even require you to provide an ID to make sure you aren't laundering money. Centralized exchanges usually have high liquidity because they have a lot of users trading on them. Using our swimming pool example, this would be like if there were a lot of people playing in the swimming pool at the same time. The swimming pool would be larger and it would be easier for someone to jump in and start swimming. Another type of liquidity pool is called a decentralized exchange. These exchanges are not run by any central authority. Instead, they are run by the users of the exchange. This would be like at a lake without a lifeguard. There may still be signs and rules and barriers that prevent bad behavior, but ultimately, users are responsible for their own safety. Decentralized exchanges usually have lower liquidity because there are fewer users trading on them. Which liquidity pool should I choose? The liquidity pool you choose will depend on a few different factors. First, you need to decide if you want to use a centralized or decentralized exchange. Second, you need to decide if you want to trade with other users or if you want to trade with the liquidity providers directly. And third, you need to decide if you want to trade with fiat currency or with cryptocurrency. If you want to use a centralized exchange, you will need to provide an ID and you may be subject to KYC, Know Your Customer rules. If you want to use a decentralized exchange, you will not need to provide an ID, but you may have to pay higher fees. If you want to trade with other users, you will need to find an exchange that supports this. And if you want to trade with liquidity providers directly, you will need to find an exchange that supports this. There's no right or wrong answer. Each one has its own set of pros and cons. It's up to you to decide which one is right for you. Okay, so by now we should probably review the basics. Liquidity pools play an important role in providing liquidity to the market. This is because there is more liquidity in the market. It means that there are more buyers and sellers who are willing to trade. This liquidity can help to make the market more efficient by allowing people to buy and sell assets more easily. Another thing that you should know about liquidity pools is that they can be used to earn passive income. This is done through a process called liquidity mining. In liquidity mining, users can provide liquidity to the pool in exchange for a portion of the fees that are generated from trading. Using the example of the swimming pool, it would be like adding water to the pool in exchange for a cut of the entrance fees. This is a great way to earn passive income because you can provide liquidity to the market without having to actively trade. There are, however, some risks. The first risk is that the liquidity pools can be hacked. This is because liquidity pools usually hold a lot of assets, which makes them a target for hackers. Another risk is that liquidity pools can be subject to price manipulation. This is because the people who provide liquidity to the pool can trade with each other to manipulate the price. Lastly, liquidity pools can be subject to liquidity shocks. This is when the liquidity in the pool dries up, which can make it difficult to trade. These are just a few of the things you should know about the risks associated with liquidity pools. Now that you know about the risk and importance of liquidity pools, you might want to know what else could happen when liquidity pools dry up. In a liquidity shock, the price of the assets in the pool can drop sharply. This is because fewer buyers and sellers are willing to trade. A liquidity shock can also cause the pool to close down, which can make it difficult to get your money out. This is because liquidity providers may not be able to find a buyer for their assets. This would be like if the swimming pool closed down and you couldn't get your entry fee back. So how exactly are liquidity pools different from other exchanges? Liquidity pools are different from other exchanges in a few ways. First, liquidity pools don't have order books. This means that there is no need to wait for your order to be matched with another order before it gets executed. Instead, your trade is executed immediately against the liquidity pool. This would be like if there was a complicated notebook of when and who was in the pool and how much space they took up. It would be very hard to keep track of, and liquidity pools don't have that. This takes the complication out of the system by making it more streamlined. It's like the pool shrinks or grows depending on liquidity providers, rather than counting how many people were in the pool. Liquidity pools also don't charge trading fees. Instead, they make their money by charging a small amount of interest on the money that is loaned to the liquidity providers. Liquidity pools can be a great way to get your feet wet in the world of cryptocurrency, trading pun intended. They are simpler than other exchanges and don't charge trading fees, so you can focus on learning how to trade without worrying about losing money to fees. Just make sure the liquidity pool you choose has strong security so that the thieves don't come in and take out all the water. Or you might be exposed with your pants down while swimming. To get started with liquidity pools, you can try dipping your toes in the water before diving head first. This means providing what you can afford to lose without putting too much at risk. However, you still do need a minimum amount of currency to get started, which is called the initial margin. This is to ensure that liquidity providers don't just leave the pool immediately after there's a big move in the market. The initial margin is there to give liquidity providers a chance to adjust their positions and make sure that they don't get taken out by the market. Basically, it would be like if you had to put up $100 to get in the pool, but you could only take out $90. The other $10 would be there to give liquidity providers a buffer in case the market moves against them. This rule is in place to protect liquidity providers and keep the pool full, so that traders can continue to get their orders executed. You would also need a Web 3.0 enabled wallet to trade on a liquidity pool. This is because liquidity pools are most commonly decentralized exchanges that typically run on Web 3.0 applications. So if you don't have a Web 3.0 enabled wallet, you won't be able to trade on liquidity pools. There are a few different types of wallets that you can use, but MetaMask is one of the most popular wallets because it's easy to set up and use. Other blockchains are also supported by liquidity pools, but Ethereum is the most popular one. This is because a lot of the decentralized applications that are built on Ethereum use liquidity pools to trade tokens. The problem with Ethereum is that there is a lot of gas. Gas fees are the fees that you have to pay to use the Ethereum network. These fees can be high, so it's important to factor them into your trading strategy. This can be a necessary evil, as if you were swimming in a pool and you didn't have any gas to power your swim. You'd probably just float there and eventually drown. That's why you should have extra ETH in your wallet to keep you moving. ETH is like the fuel that runs the Ethereum network and allows you to do things like trade on liquidity pools. More and more blockchains are starting to come up with their own liquidity pools. If you decide to use their pools, the gas fees may be different. For example, it would be like if a pool in a different city had no gas fees, and you can swim and trade high fives with other swimmers in the pool all day. And that's liquidity pools in a nutshell. Liquidity pools are an important part of the crypto space, and they play a big role in making sure that the markets are efficient. To summarize, a liquidity pool is like a swimming pool that changes capacity based on the amount of water participants bring. Liquidity providers are like the maintenance team that makes sure the pool doesn't run out of water. The initial margin is like the entrance fee that liquidity providers have to pay to get into the pool. Decentralized smart contracts or centralized authorities are like the lifeguards or rule board, making sure everyone is playing fair. And gas fees are like the energy you need to swim in the pool. We hope this video helped you understand liquidity pools and how they work. Please make sure to share and subscribe to our channel. If you have any questions, feel free to leave them in the comment section below. Thanks for watching.